Yeah, so then we're going to finish the chapter 7 and 8 handout. We are not going to have the practice exam or anything like that on it. We'll do that when we come back. Next week, you guys are off. It's spring break next week, so I don't want to give you guys stuff to do over break. So anyway, so when we come back, we will we'll do the practice exam. This might do a problem or two out of the book too, and then have the exam. But we'll worry about that later. So the next time we meet will actually be on 20th. Spring break is 12 through something. So
I have a question.
Yeah.
I saw that that our assignments that are due tomorrow, there's an assignment called the Anthony's case. I just wanted to see if like what
that shouldn't be in there.
Okay.
That's a completely different class. So yeah, that would be bad. Let's see here. Oh my gosh, it's accounting 330. I have sincere apologies. That is not supposed to be in there. That's an auditing case, and those of you that go into accounting, you will probably have that, but not just yet. Sorry about that.
Thank you. I just wanted to check in.
Yeah, no, I'm glad. I'm very glad you told me, because that, yeah, that's bad. All right, so I think I'll break from the 12th through the. They probably say 12th through the 17th, I imagine. So. So our next class will be April 20th. Yep. Yeah, so April 20th will be our next class. And then we'll pick up the chapter 7 and 8 stuff at that time. Okay, let's go ahead and pull up the handout. I think this should be a short class. Okay, let's see here. Okay, so let's go. I'll just use this on the screen here. All right. In accounting, we have a thing called the matching principle. And the matching principle is that you match your revenues and the expenses and the related expenses in the same period. And it's one of those things that's so obvious that it might seem a little odd to have a rule for it. But for example, revenues in 2020, so you match with the expenses for 2020. And at this point, you're probably saying, well, duh. But So you're going to match the, the revenues and the expenses should be matched in the years in which they occur. And so that's really, that goes through all of accounting. Now, when it comes to accounts receivable, there's a problem. And that is, you might record a sale in one year. I'm going to actually add something here. So you record the sale, you record the accounts receivable in 2020. However, suppose that accounts receivable is found to be uncollectible in the next year. All right, so there's a problem there. And now the problem is that the problem with accounts receivable is, first of all, up until this point, we've always assumed that accounts receivable will all be paid. And for some companies, that's true, but for a lot of companies, it's not, especially if you have a lot of accounts receivable. Things just happen. People go bankrupt. People die. People leave the country. Whatever it is, a lot of times you don't collect all your accounts receivable. Now, the problem is that when you make the sale, you don't know who is not going to be able to pay. You don't know who's going to go bankrupt, you don't know who's going to die, you don't know. So there's all these things that you don't know. Now, you know that some of them are going to be collected, but you don't know which ones aren't. And that's a problem. And the problem is that if there is a bad debt expense, it should be in the same year as the sale. So that's a problem because you don't know who it is. If you knew, well, first of all, if you knew who it was, you probably wouldn't sell them in the first place. But you don't know who it is, who might go bankrupt, who might die, who might leave the company. You don't know those things. So the question is, what do you do? So there's going to be an expense, but you don't know who it is. So you can't just write off somebody's account. That account might be good. If you randomly write off someone's account, that account might be a good account, and one of the accounts you don't write off. And so the question is, well, how do you do it? And that's kind of what this chapter is about: is how do we get that expense into the correct year, into matching up with the correct period that it goes to. We don't actually know who's going to go bad. So what we have to do is make an estimate. So, excuse me. So we have to make just an estimate of how much of these accounts receivable are we not going to collect. Now, it's an estimate. It's not going to be exact, 100% correct. Never is. However, it's an attempt to put on the books the expense that we believe is going to happen because of uncollectible accounts. Okay. So here is this sale that we had. We recorded the sale here. Let's do it in red. And we find out that account is uncollectible here. And this is an expense that is really for 2020. So here's what we're going to do. We are going to move this back to, say, the year end, we're not going to record the expense here. And we're going to make a an estimate. Sorry. Oh, excuse me. I didn't do this very well. Sorry, guys. So we're going to make a an expense estimate on in year end, say 12/31. So we're going to expense it in, it's going to be in 2020, but it's going to have to be an estimate because we don't know exactly who's going to go bad. This account went bad. Could be other, other ones that went bad, and so on and so forth. Hey, my $1,000 just. Okay. So we're going to make an estimate of what's going to go bad. And we're doing that so that we can get this expense to match up with the revenues or the sales. All right, so there's going to be an estimate. And so that's kind of what the whole thing is here. Now, we call it the allowance method because there's actually going to be an allowance account. When we write this expense up, the expense is going to be the debit. You say, okay, well, what's the credit? Well, it can't be accounts receivable because we don't know who's going to go bad. So we use what they call an allowance account. It's going to be a contra account, which we'll talk about in a second. Okay, so allowance methods. There's actually two allowance methods. There's this one and that one. There's this one, percentage of sales method, and this is the one that we'll use in this class. There is another one, percent of accounts receivable, which we're not going to go over in this class. It's a similar one. The percentage of sales one is based on sales. The percentage of accounts receivable method is based on, you may have guessed, accounts receivable. We're going to use a percentage of sales one. It's an easier one, but either one of these is acceptable. So, they're both GAAP. They're both generally accepted accounting principles. They both can be used. I don't think I ever told you guys about GAAP. That's something I should. It just occurred to me. I don't think I ever talked about it. You guys probably want to think I'm saying crazy stuff here. Well, I do say crazy stuff. This is not as crazy. You'll hear something called GAAP a lot, and GAAP stands for Generally Accepted Accounting Principles, and these are just the rules. So when you hear someone talk about GAAP, is that GAAP? What they're talking about is that Generally Accepted Accounting Principles. So these are just the rules. Oops. Oopsie daisy. Let's go back here. Yeah, so this is so if you hear the term GAAP, that's what it's talking about. So GAAP is the accounting rules are called GAAP. So this would be a GAAP. These are GAAP rules. So the percentage of net sales method, it's a GAAP. rule, percentage of accounts receivable method. That's a GAAP rule. That it's accepted. That's an accepted rule. and yeah, so GAAP is are the accounting rules. And, we're learning. Okay. I should have told you that on day one, and it just occurred to me I probably did. All right, so here we have the trial balance before adjustments. What's the following balances? Okay, so here are some accounts we have. We have accounts receivable. We have allowance for doubtful accounts. And those two kind of go together. And we also have this sales account. Okay, so here's what we have right now. This allowance account has 55,000 in it. The allowance for doubtful accounts is sometimes called the allowance for uncollectible accounts. It has 1,000. So these two kind of go against each other, and you can kind of see that the accounts receivable is a debit, and this allowance for doubtful accounts is a credit. So, you know, and this is kind of left over from the previous year. If this is at year end, but there's still some left in that allowance account. So I should have put this on 2 pages. So it would look like this. So on the balance sheet, underneath assets, it would actually be current assets, but assets is good enough for now. It would look like this. What's going on here? And this would be the what they call the net accounts receivable. Now we're going to make an adjustment to this account to bump it up some, because this is still left over from the previous year. But this would be the actual amount that they would use on the in the assets. You know, you would actually tell people, look, don't expect to get this. We're not going to get that. You got to subtract some out. So anyway, let's go ahead and make the entry here. Okay, so here we go. We're going to make an estimate. It's not going to be 100% correct. Never is. You don't have a crystal ball. And we estimate that 2% of the net sales will be uncollectible. Okay, so here's a question. What would be our estimate? Okay, it's 2% of net sales. So if you think you know what the amount is, either yell it out or put it in chat if you like. So 2% of the sale, and here's the sales.
$60,000.
Close. I think it's 6,000. Let's see, the sales are.
Yeah, 6. I putting 2%. I'm sorry.
Okay, yeah. No, but that's exactly how you do it though. You multiply it out. So this would be. Two equals. Okay, so 6,000 would be our. Our estimate. Putting in extra things here. Okay, so this would be our. So our journal entries look like this. So 12/31. So we know that some of these accounts receivable will not be collected. Oh, man, I forgot I did this. It's supposed to be. Okay, so this would be. So uncollectible account expense. If you guys put uncollectible expense, that's fine. And then we'll have our allowance for doubtful accounts. Two older ones. Excuse me. Sometimes it's called allowance for uncollectible accounts. There's a few different ways you can write that. And so this is our estimate. And what that has done is it's pulled this expense in. You know, we're going to find out about accounts that are not collectible in the next year. But we're going to pull that expense into the current year. I should put years on here. I should put the date of the year in there. And I probably did it so that I don't get caught. Anyway, so this is kind of what it would look like. Should put the accounts in here. So we have accounts receivable. And we have the allowance for doubtful accounts. And I'm going to do this. You don't have to put this in. So I'm just going to just kind of make the T accounts to kind of give you guys and again, you do not have to do this. Okay, so we have 85,000 in our accounts receivable. And our doubtful accounts has At least initially it had $1,000 in it. Oops, that's too many. And we just added another $6,000. Okay, so there's 7,000 now in that account. So we have accounts receivable are that, and our allowance for doubtful accounts is that. Okay, so if we were to do the balance sheet after we did this, you guys would probably guess this would be 7,000. And what's 55 minus 48? So it would be 48,000. So this would be, excuse me. So this would be on the balance sheet. And so what we tell people is say, look, we're not going to collect 55,000. You know, that's how much is owed to us. However, we know that some of these accounts are not going to be able to be collected. So we really think we're going to collect 48,000. So that is what you should expect, or something close to it, for these accounts receivable. And this is what you'd add into your total assets, would be this. And up here, you know, in this uncollectible expense, this would go on the income statement. You know, this would be matched up to the sales. So the sales would be 300,000. However, what did I do here? However, we are going to reduce our income by 6,000 because we say, okay, look, we're not going to collect all 300,000 of these. We are going to have, this is an estimate, but we estimate that we are not going to collect 6,000. So it'll be subtracted. Whatever we, you know, on our income statement, we'll have a bunch of other expenses and stuff. But one of the things we'll have in there is this uncollectible account expense. So it'll say, okay, we definitely made sales of 300,000, but 6,000 probably won't be collected. Right. So again, you know, it's kind of a lot of jumping around, but it's basically for this idea that the revenues for 2020 should be matched with expenses for 2020. And again, you know, so obviously you think, well, why would you even bother to write that down? But that's what leads to this estimate stuff. Any question on that? Oh, I should make another arrow. I wish there's a way to just have these shapes up all the time. It probably is. Oops. Didn't use that shape correctly. Okay. Okay, let's do the next one. Now the next one's a little bit trickier. We still have those. And here we have this. And I think, well we did talk about this before. To get the net sales, so here's where the sales, but people return 10,000 of stuff. So the net sales will be whatever they have, subtract those. All right. All right. Yeah. I'm making a mess out of things today. Just because that's the kind of person I am. Okay, so oops. So our net sale, excuse me, our net sales will be 620,000. 620,000. So this is what you're going to use to do your calculations. Because we really didn't sell 630,000. People brought back 10,000 of it. So we're going to use this of our net sales. So I will be quiet and see if you guys can figure out the journal entry for it. Okay, so that would be our journal entry. Copy it. You don't need to put this in, but I just kind of want to show you. All this up. Ooh. A little too far here. Okay, so it started out at 85,000 minus 2,000. So this would have been 85,000. 2,000. 18,600. Okay, let me clean this up a little bit. Yeah, lost that. Okay, so this would be 85,000 for one thing. This would be minus 18,600. So this would be, that would not be 18,600. Bad teacher, bad teacher. Minus 20,000, so what is that? 64. 400. I'm going to check that. All right, so 85,000. 20,600. Yeah. Okay, so and this would be the amount that would be on there. Sometimes you'll have companies that will just, oftentimes I should say, you'll have companies that will just put the net accounts receivable. They won't even give you this stuff up here. They'll just say, you know, here's the net accounts receivable. Now they'll have a note somewhere how they got that, but this is, they'll say, show them and say, look, this is what we think we're going to collect on. And to some extent, I mean, this doesn't matter, you know what I mean? You're not going to collect 85,000 anyway, so why put it on there? This is what you're going to collect. Question on that? Okay, let's show you one thing here. Let's see. I'll afford. So this is the Ford Motor Company. This is a few years back. This is 2017. I should get a newer one. But anyway, so this is them. This is what they filed with the Securities and Exchange Commission, which is just a government agency, big, powerful government agency. But they'll have their financial statements in here. They're usually about halfway down. Here we go. So this is Ford Motor Company. And this thing has a couple 235 pages. But anyway, so this is their income statement, fairly similar to what we are used to seeing, right? Revenues, costs and expenses, they're taking everything out, and here's their income. So revenues, money coming in, cost, expenses, money going out, and income. There's a few hoops in there, but basically the same thing. Comprehensive income is a wacky thing that we're not going to talk about. So here, you'll see there, I don't know if I can zoom this in or not. Nope. Okay. So here you'll see their financial service, finance receivable net. So what they're telling you is that these receivables, they've already taken out the allowance. And they say, look, if you want to know more about it, there's note 10 down below. You can go take a look at it. And then here they have trade and other receivable. They say right in what the allowances are. So the allowances were $392. So this is going to be the net. You know, they subtracted these out. So they are actually owed more than what are these? Are millions or something? They got big numbers here. So this is if these are in millions, this is $11 billion. So they're saying of the $11 billion that that's after they subtracted out 392 million. And for 2017, it's 412 million of the 10 billion that they're owed, 10.5 billion. But it's exactly the same as we just did. There's no, you know, and it's kind of funny. I don't know if it's funny or not, but the interesting thing about accounting is that no matter how big and complex the companies are, Ford, huge company, complex, yeah, financing, production, market, all these different areas, everything can basically be put into 5 basic categories: revenues, expenses, assets, liabilities, and equity. You know, the wildest, most complex transactions you can think of all fit in those 5 categories. So Ford Motor Company, while it has, you know, it's got a lot of stuff in there, it's the same as any other company when it comes to doing this stuff. So anyway, long story short, for accounts receivable, like we're doing, a lot of companies will just show the net amount. They'll say, okay, here's what you're going to collect. And you know, the total amount really doesn't matter because you're not going to collect that anyways. If you want to read about it, here's a note, go look at it. But yeah, so a lot of companies will actually just put the net amount on the books. Any question on that?
No.
No? Okay, good. So that's it. So what we'll do is I'll put a submit thing on that in Blackboard, one that relates to this class, and I think the exam's due tomorrow. I think it's due tomorrow. Either tomorrow or Saturday. I can't remember. Regardless, you can turn it in. It's not, you're not going to mark late. But anyway, we will not meet again until the 20th. So let me share that. So have a good break. Stay safe, and I will see you on the 20th. Any questions on any of that?
No.
Okay.
Can I still do the old exams that I missed?
Absolutely. Yep.
Are they still in the listing?
They should be in your email.
On my email, okay.
Yeah. Now, so check your email. Now, if they're not in your email, email me, and we'll take a look at what you need to turn in. But check in your email first. They should be in there, and they're not in Blackboard because there's different forms of the test, so you got to turn the form that you were sent, basically. So yeah, but if you look through your email, if you still can't find them, go ahead and give me an email. Send me an email. I'll look up what you need.
Okay, thanks.
Yeah, but and that goes for everybody though. Yeah, you can turn in stuff without penalty. So if you didn't turn something in and it's late or something, turn it in. There's no reason not to turn it in. I'll put it that way.
Right.
All right. Any questions?
No, that'll be all. Thank you.
Okay, very good. Okay, have a good break, everybody. I will see you in a little less than 2 weeks. It'll be it'll be 12 days. I'll see you in 12 days. All right.
Okay, thank you. Have a good one.
Thank you, Professor. Have a good one.
Thank you, Professor.
Thanks, guys.